Are you curious how the latest economic shifts could signal a crisis ahead?
Absolutely. Experts like Torsten Slok from Apollo Group and Mitch Beekler are raising alarms about potential supply shocks and more.
In this video, we've harnessed AI to distill their compelling insights into quick, actionable takeaways.
Stay alert. We'll cover upcoming changes in consumer behavior and their impacts on the housing market.
So stick around. Our analysis will equip you to navigate these turbulent times.
Just remember, this content is for educational purposes, so be informed in your decisions.
George Gammon introduces Apollo Group's alarming analysis predicting a significant crisis in June.
In his report, Torsten Slok warns of supply shocks, predicting empty shelves driven by economic factors.
Slok emphasizes that the upcoming months could see supply shocks similar to those experienced in 2020.
Gammon affirms that these claims are backed by substantial data from Apollo.
What insights does Torsten Slok provide regarding tariffs?
Slok mentions that tariffs are causing a significant drop in container departures, leading to immediate supply issues.
What observations does George Gammon make regarding current consumer behavior?
Gammon notes that consumers are feeling financial pressure, which is leading to reduced spending.
What does Slok indicate regarding the impact on small businesses?
Slok indicates that many small to mid-sized businesses will likely struggle to survive the predicted economic challenges.
What does Torsten Slok foresee for the summer of 2025?
He anticipates a severe recession with store shortages reminiscent of past economic shocks.
In conclusion, George Gammon urges viewers to stay informed and prepared for the coming crisis.
He stresses the importance of proactive planning for both policymakers and consumers in these unpredictable times.
Today, we're examining the economic analysis provided by Mitch Beekler regarding the recent UPS layoffs and their implications for broader economic distress.
Mitch highlights that consumer sentiment has significantly dropped, indicating challenges for our highly leveraged economy.
Mitch Beekler emphasizes the importance of the recent announcement from UPS about laying off 20,000 staff, suggesting it's a sign of serious changes in the economic landscape.
He indicates that such layoffs serve as a critical indicator of ongoing economic issues.
Mitch notes that consumer confidence has waned for 5 straight months, reaching its lowest level since the pandemic.
This trend is concerning and illustrates that consumers are finding it challenging to navigate the current economic situation.
According to Mitch, the Case-Shiller Index signals that 2025 could experience a significant adjustment in home prices.
He underscores that affordability continues to be a significant barrier for potential buyers.
Mitch raises concerns about the FDIC's insufficient funds to safeguard consumer deposits, emphasized by troubling statistics.
He warns that with inadequate reserves against total liabilities, consumers should approach their banking security with caution.
Mitch predicts that 2025 may be a difficult year, characterized by rising unemployment and declining real estate values.
He urges consumers to be prepared for potential economic consequences.
In summary, Mitch encourages viewers to monitor consumer confidence and job market developments closely.
He recommends paying attention to housing market trends as noteworthy changes are anticipated soon.
Today, we're exploring insights from Stephan on how saving your first $10,000 can dramatically change your life.
According to Graham, this initial amount lays the foundation for greater financial confidence and opportunities.
Graham emphasizes that saving your first $10,000 provides the financial confidence needed to feel empowered.
He notes that this milestone allows individuals to manage emergencies without going into debt, significantly easing financial stress. Graham points out that having $10,000 enables you to handle unexpected costs, such as car repairs or vet bills.
This creates a safety net that alleviates daily financial pressures. Graham mentions that this amount allows for the freedom to explore further education or business opportunities.
He believes that this newfound financial stability encourages more intentional spending. Graham explains that moving towards $100,000 fosters a sense of security against major financial emergencies.
At this stage, individuals can explore investment opportunities to further secure their financial growth. What does Graham predict for those reaching $100,000?
Graham expects this milestone to initiate substantial investment returns, thereby amplifying wealth.
Graham concludes that reaching financial milestones requires intentional living and smart financial decisions.
He advises being mindful of spending while making investments for the future.
Welcome to today's discussion, where we unpack insights from Clem on supply chain disruptions and gold predictions.
Clem highlights concerns regarding essential goods that could lead to increased inflation and market instability.
Clem suggests that the current economic threats revolve around trade conflicts and the evolving U.S. debt.
He mentions that a significant percentage of American food packaging relies on imports from China, which presents a risk.
Clem explains the potential for inflation spikes if essential packaging isn't delivered.
He emphasizes the risk of consumer panic resulting from supermarket shortages. Clem's analysis indicates that rising global tensions lead to heightened demand for gold.
He believes gold serves as a crucial safeguard against geopolitical instability. What does Clem foresee for gold's future given the current market conditions?
He envisions substantial upward movement in gold prices as systemic risks magnify. Clem advises implementing proactive strategies to hedge against downturns, especially through gold investments.
His insights encourage a cautious approach with continuous monitoring of economic signs. Today, we're analyzing the current market situation as detailed by the technical trader's guest. They highlight a significant sell-off affecting both large and small caps.
The guest warns that we are witnessing the beginning of a potential market correction that could lead many investors to panic.
The guest at the Technical Traders stresses that many investors underestimate the risks of holding individual stocks and relying solely on dividends.
They emphasize the importance of protecting capital and being mindful of long-term retirement goals in this volatile environment.
The guest discusses how panic selling is likely to rise as volatility persists in the market.
They specifically mention declines in major tech stocks like Meta and Microsoft, contributing to overall market sell-offs.
The guest highlights that relying on dividend yields as a hedge against market declines can be misleading.
They argue that traditional hedging strategies may be ineffective during significant market downturns.
The guest notes that impending earnings reports could spark increased market turmoil and fluctuations.
Defensive sector plays such as utilities are demonstrating resilience and may signify a shift in investor strategy.
The guest predicts that while some upward movement is possible, the market typically tests lower levels.
Their analysis suggests a potential dead cat bounce could occur before a stronger downward correction.
The guest concludes that protecting capital should be the primary focus for investors during this turbulent time.
They advise staying informed on market indicators to help navigate the challenging waters ahead.
Today, we're exploring key insights from McGlone regarding inflation, deflation, and signals of a potential global recession.
Mike suggests that rising gold prices amidst increasing unemployment may indicate broader economic issues.
Mike highlights the correlation between rising unemployment and increases in gold and silver values, a crucial economic signal to watch.
As Mike observes, ongoing market trends echo historical downturn patterns. Mike states that the current inflation narrative might be transitory, with more significant deflationary pressures expected.
What could this mean for consumers amid such economic changes?
Great question. Mike emphasizes that historically, deflation follows periods of inflation, altering consumer behavior.
Mike explains the importance of the gold-silver ratio as a predictor of potential economic downturns.
He notes that historical trends often show such ratios going hand in hand with imminent recessions.
According to Mike's analysis, gold is expected to continue appreciating as the economic environment deteriorates.
In contrast, Bitcoin's ties to the stock market may pose challenges moving forward.
Mike forecasts that if existing trends continue, deflationary pressures may dominate the economic narrative by year-end.
This change would represent a drastic shift from the recent inflationary climate.
In conclusion, Mike stresses the importance of considering gold as a safe investment during turbulent market conditions.
He further advises a cautious approach towards risky assets while navigating these challenging economic times.
What a roller coaster of insights from our amazing guests today.
Absolutely. Mike McGlone highlighted the historical relationship between unemployment and precious metal prices.
And the technical traders emphasized the need for capital protection amid potential market corrections.
Exactly. Plus, Clem Chambers raised alarm bells about how supply chain issues will impact inflation.
That's a pivotal point. And then we had Stephan, who argues that reaching financial milestones like $10,000 transforms your financial mindset.
Right. But Mitch Beekler wasn't too optimistic, underscoring the risks posed by national debt and consumer confidence.
Speaking of risks, Torsten Slok painted a dire picture of what June might hold with expected supply chain disruptions.
It's fascinating to see where they aligned, especially on monitoring inflation as a crucial concern.
And yet, their take on how to approach these issues was quite different.
Yes, and that divergence is what makes financial discussions so engaging.
If you enjoyed today's insights, please give us a thumbs up and subscribe for more expert analyses.
Our channel thrives on your support, helping us bring more valuable content like we saw today.
Don't miss our next video, where we'll unpack the intricacies of global trade. Stay tuned.